Yeah, that's, Preeti was asking about the foreign properties. So the total rule, I'm just saying that again for the record that here, that people after that they can listen to that. If they have the total properties that they have outside Canada, that goes over $100,000, and it doesn't mean the market value, the current market value. It's about the value that they bought it for. So for example, they bought a piece of property for $30,000 back in their country, and they have some stocks that is $40,000. They bought it for $40,000, and some other stock. If the total goes over $100,000, they have to declare all of it. And then if they sell it in capital gain, they have to declare the capital gain. If they sell it in loss, they have to declare the loss. If they make any income out of that one, like dividend, like interest, if they make any rental income, all of them, they need to declare that one. And to be honest, a lot of people, they do not declare that one. And you cannot force people to declare it. But you should remind them about the consequences if they find out. So you're
Yes,
not in charge of that
yes,
one.
yes, but Professor, in case it is an inheritance that they got, that is, they got a plot of land, something like that, as inheritance, then should they declare that part?
No, inheritance is tax. That's, you don't need.
Okay.
Because technically you have never paid anything. So the value of that inheritance is less than $100,000. But if you have other assets that goes over $100,000, then you need to declare that inheritance as well. Because
And
if you
depending
have
upon the market value
other
then.
market value, it's about the amount that you bought it for. So if an inheritance, let me just share my screen and explain it to you. And it's very short. Okay. So, just let me share my screen and let's say that we have a person who has inherited a piece of property. So how much did they pay for that one? It's zero. But the ACB, or the adjusted cost base for that one, is what? Is the fair market value when they got the property. Let's say that when they got the property, this is the payment. But when they got the property, the market value was $1 million. That's, let's say, fairly foreign properties we have this. So, and now after 10 years being in Canada, this property, this was inherited, and they have not declared that one. But if they have any other assets, so this property has gone up in value, and now it's $1.5 million. And then they sell that one. So this $5 million for the Canadian tax purpose is considered as a capital gain. And the person has to pay the tax on the capital gain. I explained it how it taxed. The first $250,000 is 50% taxable. Anything over that one is 66% taxable. What will happen if they paid any tax in their country for that gain? So that will be considered as a foreign tax credit. Depending on the country, you can deduct up to 100% of that money. So let's say that they considered here, they said that you need to pay $700,000 tax on this $5 million gross. And you have paid, let's say, $100,000 tax in the country. So the total amount that you need to pay is $600,000. But this FTC, foreign tax credit, it depends on which country you are claiming them. For example, with the US, you can claim all of them, foreign tax credits. But for some other countries, for some of the countries, they do not accept anything. So technically, if you have paid $100,000 for that, capital gain in your country, still you have to pay $700,000. And yeah, that's And this case is very complicated, but if they do not declare that one, then it has a huge penalty. If they don't fill out that form and this form, if they don't fill out that one, then they're gonna have a penalty and a lot of stuff. I'm not going to dive into the details of that one, but the penalty that they need to pay is very high. Is it clear?
Yes, Professor.
Okay, good. So let's start. Okay, we have 3. Okay, so we have 6 on the call. This to be 9, 10. Okay, so in the last session, we talked about the T1 general, and we discussed some of the lines. We talked about the T4 and the other forms that you have. And I think we explained the different business incomes. And we talked about the net income and how the system in general works. So the first thing is that the moving expense. You see here, this moving expense, the person is eligible and they need to fill out this T1-M, this form. So if the person moves for the purpose of education or work, move more than 40 kilometers closer to that place, then they can claim the moving expenses. But moving to Canada, if you are new in Canada, moving to Canada for the first time doesn't count as a move. So for example, you are here in Vancouver, then you find a job in Victoria. So you move from Vancouver to Victoria, everything that you pay for that move, it has a form. I'm not going to jump into the detail of that one. Maybe in the future I talk about that one. But now, if you move from Vancouver to Victoria for the job, because you are, the new place definitely is 40 kilometers more closer to the new place, that your workplace, so you can claim all the moving expenses, and you're going to get a credit for that one. For the RPP, this stuff here, RRSP, FHSA, I will explain it in the next 2 sessions, a bunch of them. I talked about the union due. You remember in the T4, we talked about the box 44. When you are a member of a union, then you have to pay for them. For example, if you are a CPA in Canada, you have to pay to CPA Canada for them. They charge you handsomely. They charge about $2,000 a year. And then you can deduct it here from your net income to make your net income for the tax purposes. And some other things is the UCCB, it's no longer exists for old days. And childcare expense, if you have a child and you send your babies to the daycare, these T778, it's very important because you can claim based on the age. There is a limit. I think the minimum is $8,000, the maximum is $12,000. You can claim for that childcare. And it covers even some of the classes that they go, because when you have a child, you have to send them to different classes. So you can claim that number here. And if your client says that, always have that one. And if the client says that I have a child, always, these are the tips that you can get clients for with them. You're talking to the client and you said that, okay, do you have a child? Because you want to file their return. So they said yes. So the first thing that comes to your mind, you should check that if they had any daycare expenses, classes, anything, you can use that T778 for that number. And they can deduct it. For example, if they pay $10,000 and they're eligible, so they can deduct all the $10,000 here. So this is a very big, good opportunity for you to give tips about that one. And when you want to keep the client, I have this experience with tax filing clients, giving these tips and helping them to save more on their taxes is what will make them happier to pay your fee. And gradually you're going to charge higher fees. For example, for the first year, you may not charge that much, but for the second year, the years after, you can charge more. And then the next thing that happens is it's gonna bring you a lot of referrals. Referral most of the time comes with your knowledge. If you can demonstrate, show them that you have the knowledge, it will, and then ask them, show them your knowledge, then ask them that, okay, if you have any friends that might be interested, I would be happy to help them file their taxes. And they will talk to them. These word of mouth is the endless source for you to get referrals. Okay, so I go grab some water. So then the support payment, don't bother about that. It's about those who have divorce and stuff like that you're gonna definitely see them in the future, but for now, I'm not going to talk about that one. And this one, it's one of the lines that I made huge strategies on that one. And this is the idea. If you get a loan, so what you need to pay on the loan, you need to pay interest, yeah?
Interest.
So if you invest that loan, then you can deduct the interest here. So let's say that the person has a high tax bracket, for example, 50% tax, and they pay $10,000 interest. Since they can deduct it here, they're gonna save $5,000 on the tax. Yeah. So how much is the net amount of interest that they paid? $5,000. Yeah. This is called effective interest rate. You see, sometimes, and I have done a lot of great strategies for the clients with this line, this just particular line. It helps you a lot. But I will, in the second or third level, I will show you some cases that you can see about that. Okay. So are we good so far? Okay. So
Yes, sir.
now we got to the net income for the tax purposes, or net income before adjustments. And now we want to get to what? To taxable income. That net income before adjustment, now we need to do some adjustments on that one. And the adjustment that they have here, these are mostly this one is the non-capital loss from other years. If they have any business loss from the previous years, they can claim it here. And the rest, they are very complicated stuff. I'm not jumping them. They are just very advanced levels. So now it's time to do what? It's time to start and calculate the tax. We calculate the taxable amount. Now we want to calculate the tax. So look at here. If the amount that you're making is less than $53,000, so you're gonna pay 15% tax. It's the federal tax. Pay attention to that one. You have provincial tax as well. Then, if that money goes up from $53,000 to how much? $206,000. So you see, for example, let's say that I got $90,000. So $53,000 is deducted because we have paid 15% tax on that. For the rest, we have to pay 20%. So in this case, if I make $90,000 on the federal side, my marginal tax rate is how much? Is 20%. This is called marginal tax rate. Yeah, make sense? And now, let's say for this one, I made $93,000, for example. And so the difference is $40,000. I have to pay 20% here, so $8,000 here. $8,000 for the first bracket. Total is $16,000. Yeah, this is going to be the federal tax before credits. You remember we talked about deductible and credit. So far, whatever we deducted, they were deductible. They were not credits. And we're going to explain the credits after them. Is it clear? You understand the difference between the credit and deductible? So whatever was before this line was what? Deductibles. Whatever comes after that one are credits. Credits can get deducted directly from what? From the tax. While deductibles gets deducted from the taxable income. And for the credits, we have two different types. Non-refundable. It means that if you don't have any tax to deduct, you're not going to get that money back. And we have refundable. Refundables are those that you're going to get back if you don't have any tax to write off. Is it clear? Wonderful. Now, so you understood how the system works for the tax brackets and calculations of the tax. So I want to give you an example. I want you to calculate something. I have a client. The income, the taxable income is $255,675. Give me the amount of tax that they need. 255,675. Warren is here. Hi, Warren.
The other link wasn't working. I tried to join earlier. It wasn't working. It told me that the link was, I don't know. So initially I thought I was not going to be in class. And so
Don't worry
proceed.
about that one. Yeah, I have recorded this session.
Okay, thank you.
So, how much did you get?
Excuse me, Professor, we should calculate with 25%, yes?
25%? No. 25% is
20.
for 90. No. For 93,000. So here, let me explain it. So how much is the tax bracket? This tax bracket, look at the tax bracket. It says that anything more than 235,675. So how much is that client making? 255,000. So this is the marginal tax rate. Does that make sense? If you read the above, you can just find it, locate the bracket. Now, so if I put this number here, 255,675. So how much would be the difference? $20,000. Yeah. $20,000 times by 33%. So how much? $6,600. Yeah. Plus that number, 54. So it's gonna be
61,178.67.
Yeah, the total federal tax payable is 61,000. The total federal tax, not the payable. It's before the credit. Make sense?
Yeah.
Now, if I ask you to calculate the person with $400,000, how much would you have? The income of this person is $400,000. Now give me the number.
$108,805.
Sorry?
108,805.
Okay, how did you calculate that one?
That is 400,000 less 235,675.
Okay,
That
how much?
amount I get 164,325.
It's
I
done by,
multiply it by 33%.
okay, how much that was?
54,227. And then
Plus,
we add the 54,578.67.
and you get to that 108,000.
Yeah.
108,000. Does that make sense? How you calculate that one? The key is to find the
Yes.
upper bracket. And just if you find the proper bracket, it's very easy to calculate. Okay, good. Now let's go through the non-refundable tax credits. The credits that you're not gonna get refund for them. So the first thing is something that is called $15,000. This is the basic personal amount. It means that for anyone who is in Canada, they're gonna get that 15,000. Yeah. Then the other one is the age amount, which is maximum 8,396. And be very careful. If the clients that you are filing is the first year in Canada, this $15,000 will be prorated. For example, if they've been in Canada for 6 months, divided by 12, and they're gonna get 7,500, not 15,000. Okay. Then the age amount is anyone for age over 65. They're gonna get this number. And then, if they have any dependent means child, father, mother, those who are dependent to you. And in that case, they're gonna get another $15,000 for that person. And if the spouse or the common law partner doesn't work or doesn't use the whole $15,000 personal amount, it will be transferred to the other spouse. So technically, but if they are married, then they're not gonna get anything for the eligible dependent for the kid.
God bless you.
Yeah.
God bless you.
I will put you on mute. All right. So then the others are about the caregivers. That I'm not going to jump into those details. It has a lot of stuff for that one. Then anything that you paid for the CPP and EI, you will get credit for them. Yeah, make sense? And then I'm not going to jump to the volunteer firefighters or the stuff. They are there, but you don't need to know that one. Canada employment amount. If the person had a job in Canada, then they are entitled to that one. For 2023, it was 1,368. They're gonna get this amount of credit. So, and the others are not. Important for the student loan, you're gonna get that one. And for your tuition, you remember that form that we talked about it? So for your tuition, you're gonna get credit. Tuition is not deductible. Tuition has a credit. And how much is that credit? Look at here. All the credits will be add up and then we time by 15%. So let's say that you have paid $40,000 tuition here. It will be timed by 15%, and $6,000 will get deducted from your tax. Make sense? So now, if you have donations, you can deduct them. And for the donation, there is a separate schedule that you need to fill out. It has a great tax credit. Up to 33% of donation, you can get tax credit, which is a great number. And it can help you a lot. And even I make tax strategies for that tax donation as well. And in your advanced courses, I will explain how to make tax strategies for the people with that tax donation. Are we good so far? Clear? No question?
Yes.
Now, we get to the net federal tax. So, this is the amount that you got from the line 75. You remember line 75 was here. So, actually, it was total here. So, then for that one, you get this amount. The tax credits are there, or we have not deducted them yet. So this number comes here, the tax that you need to pay for this for that person that has, you know, $255,000. It was 61,000, or for the other ones 108,000. That comes here. Now they get some other credits. Like if they get any dividend, they're gonna get credit from that. And if they have any AMTs, I'll explain the AMT later in the next, not next, later, very later. And then you remember we talked about the foreign tax credit. It will be deducted here. See here. It will be deducted here from the taxpayer one. And then the others are not that much important. You're not gonna see them frequently. And then the total number is the net federal tax. Then the amount from this comes here. This goes here. And then if you have not paid, if you are self-employed, so you have not paid the CPP contribution on the employer side, because when I am an employee, the CPP is paid by the employer and me. When I am a self-employed, technically I'm the employee and the employer both. So the employee side and the employer side, both I have to pay. It's all come here and be added to amount that you owe. And then it's for the EI as well, and the social benefits if there is anything like that one, and the provincial tax. So this is gonna be the total tax that you should pay. Then now you're gonna get the deduction for refundable tax credit. Remember we talked about it. You have two different types of tax credit. The first one is refundable tax credit, and the other one is non-refundable tax credits. So the first thing that you're gonna get refundable tax credit is what? Is the amount that your employer has withheld from your income, your paychecks. You remember in T4, when we were talking about that one, We talked about this beautiful tax line, box 22. That box 22 is the amount of tax that they deducted from you and paid to the CRA on your behalf. So you're gonna get that money back as a refundable tax credit. It means that if you don't owe them, then you're gonna get this money all back. So some tips that you can give advice to. Someone come in and show you their what? Their T4. And you see the person's T4 is 25,000. And you know that they are married and the other spouse doesn't work. So technically, for that number, for $25,000, they're not gonna pay any tax. So what will happen? The amount of refund is gonna be this number or close to this number. You don't need to fill out the whole tax return. Just by looking to the T4, you can give them an estimate of the refund that they're gonna get. Again, these are the tips that you can get client with them, impress them, that you know your stuff, you have done your homework. Yeah. And with all of these tips, I got clients. So they are exercised, examined, and they have proven to work. You can just follow them. Okay. So
Excuse me, Professor, how can we have these forms?
technically, the clients, they will get them, or even if you are an employee, you're gonna get it from your employer. They're gonna email it to you or mail it to you, or if they don't email or mail it to you, at the end of the day, you can just check it and you're gonna see it on CRA. Because they need to share a copy of that one with you and the other copy with the CRA.
Okay.
Okay. So if you have clients that are in Quebec, they're gonna get this line as well. It's a refund that they get for the Quebec, being in Quebec. And then it's the CPP and EI overpayment. You see here, this happens when the client works for several places and their income goes over that $68,000 maximum for the CPP and EI. But they don't declare it, and you remember that we talked about it, that the first 3,500 is exempt from the CPP and EI. So technically, they have gone to different places, and the maximum is 68,000. And for different payrolls, they have to reset this one. So for example, let's say that the person has 3 T4s, T4 1, 2, and 3. Okay. For the first one, it was 70,000. So for the next one, it was 40,000. And for the last one, it's 10,000. So the only required amount of CPP and EI that they have to pay was for this one. Because with this one, they have gone over $68,000. So any income that you make over $68,000 is EI and CPP exempt. You don't need to pay that. EI and CPP exempt. So, but the employer for the second and the third place has deducted the CPP and EI from their income. So they're gonna get that CPP and EI back. Make sense? Why? Because they have overpaid the CPP. And whatever you pay during the deductions that you got during the year, they are not the final. Your final deduction is the amount that you're gonna get at the end of the year. Okay? So then there's a beautiful thing here. If your client has worked and their income is low, it has a separate schedule. can go and check the Schedule 6. But if they have work, but their income is low, then what will happen is that the Canada Worker Benefit will pay them. And I had a client yesterday. The guy had a huge amount of dividend, $120,000, and another huge amount of loss on the rental properties. So in general, they got the total taxable income was $40,000, and he got 1,500 of this number here as well. So technically, he got for the money that he didn't pay because he didn't pay any tax. But for the money that he didn't pay, he technically gets $1,300. So the refund, his refund was $1,300. See these tips? The guy has not paid any tax, but still they can get refund from the CRA, bigger refund. Are we good so far? There is another thing here that it will help you in the future. So whenever you work in Canada, you get a T4 and you pay tuition as well at the same time. For each year of this situation, you're going to get 250. Sorry, for each year that you work in Canada, you're going to get $250 credit. Let's say that you have worked in Canada full time 5 years. So it's times by 5 is 1,250. It's the credit. Now you go to the school and pay $5,000 tuition. So you're gonna get this credit back, 125,000. 1,250 will be added back as the CTC here. But you need to go to the school and have a tuition. So if you go here, now you go to the school, you are a student now, you're not gonna get that one. But if you start working and you decide to go back to the school, then you're gonna get this credit. I remember I used this, I got this credit for my CPA courses. I finished a part of them after I graduated from school. I was not full-time student. And then the other page that we have here, okay, not a lot of stuff here. Yeah. So this is mostly what you need to know for the individual tax. Do you have any question? So since we have time, let me show you another form. And I want you to see this one as well. This is for those who have business. So let's say that you qualify for all these courses and you get your license. So after that, you will get a form that is called T4A. That I'll explain it later, but now. And or you may not get, if you start, let's say that you have started filing the tax returns for them. And now you technically are a business owner. or you got your license here, you are a business owner. Now, it's your business here, and you need to fill out this form. This form is called T2125. So this is the first part, is the identification of the business activities, what you do, and then you're gonna talk about your income. So if you have sales, commission, any fee, anything, it needs to be entered here. For the professional incomes, you need to get the professional fee here. For the lawyers, accountants, CPAs, they need to do it here. So technically, you put all your incomes here, all your revenues, technically, let's call it the revenue. So, and if you have any adjustment, you need to adjust it here. At the end, you'll get to what? To the net revenue that you have here. And then after that, you should start calculating the cost of goods sold. You remember from the accounting course? Cost of goods sold. If you sell any products, you need to calculate the cost of those. So you need to calculate all the material that you have in your inventory, plus anything that you bought, plus any wages that you paid. Let's say that you have a small business making stuff, any wages that you paid, any subcontracting that you had, or anything else. And then you need to deduct what? The closing inventory, the ending inventory, you get to what? To the cost of goods sold. And then you deduct it from the total revenue, you get to what? Gross profit. You see, it's exactly like an income statement. So now you can deduct other expenses. Advertising, meals and entertainment. Don't forget, meals and entertainment is 50% done. Then, if you have bad debt, insurances, interest, if you've paid licenses, office fees, if you have bought any stationaries for the office, professional fees, management, admin fee, rent, anything that you have, utilities, everything that you have, you can deduct it. Even you have a car, you can deduct a part of the cost or the whole cost of the car here as the expense. And you need to fill out a part that is here. Yeah. If you own a house or you use a home office, if it's rent, so you need to can deduct a portion of that one as well. And then when you pay all those items, you're going to get to what? Net income. And with that net income, now you can do what? You need to pay tax. That net income is poured into your what? Your tax brackets. Remember the tax brackets? It will be added to your income. Where it will be added? You remember that one from the first page of the tax return. It will be added to here. The gross income and the net. And the total will be added here. All the net incomes you have from different businesses. So, some tips. If you own a business, you can deduct a wide range of different expenses. Okay, so when a person has a business, don't forget you need to charge them very much more. Triple your, at least charge them $200 for the business owners. And they need to provide you with these numbers. You don't need to do the bookkeeping stuff for them. If they ask you to do the bookkeeping stuff, again, charge them. Yep. Is it clear? So I want to stop here. And then in the next session, what we're going to do, we're going to go on the software. And we're going to discuss how we can enter all these numbers in the software and file the tax return. How does that sound? Yeah,
Thank you.
yeah, we're gonna go more in practice next session. It's gonna be fun because all of you gonna participate. We're gonna do some trainings at the same time. We're gonna get some, what do you call it? We're gonna get wet. You were swimming out of the pool now. Next session, I wanna throw you into. Okay, good. So any question? Nothing?
Yes, I have a question.
Go ahead.
If the client says something like, for example, rent by mistake or right,
Okay.
are we responsible?
No,
Okay.
you are just tax preparer. The responsibility of the numbers is on them.
Okay, thank you.
And be very careful about something that is called contingent fee. Do not ask the client that I will get, for example, 20% of your return refund. If you do that one, then they have the right, they can sue you, the CRA will come after. It's a very important key when you give them the price for your fee. Contingent fee
Yes.
in any professional business here in Canada, especially financial professionals, it's not allowed. It's not legal. In the US, it's pretty legal for the lawyers, accountants. But even in the States for the IRS, it's not legal.
Okay, thank you.
It means that I'm helping you to ditch the government, then you're gonna pay a portion of that. That doesn't work. Did I give you a clear answer?
Yes, thank you.
Okay. No other questions?